Disaster Assistance for Retirement Plans. My name is Maureen Pesic, and I will be facilitating this webinar. S. Darren Watson is an ERISA attorney and pension educator in solo practice in Santa Barbara, California. He received his bachelor degree in accounting from Brigham Young University and his law degree from UCLA Law School. He is the author of Who's the Employer? A Guide to Employee and Aggregation Issues Affecting Qualified Plans, with the 7th edition released this year exclusively on ERISApedia.com. He is also a senior editor of the Journal of Pension Benefits and is of counsel to the Forensic Benefits Law Center. Darren's varied experiences range from doing stand-up comedy, yes, even about ERISA, to serving as a Mormon missionary, to editing and writing books and newsletters on a variety of topics. We are very excited to have Darren with us this afternoon, but before we begin, I have a few housekeeping items to share. All of your lines are muted, so if you would like to ask a question, you can type it into the GoToWebinar dashboard under the Questions section. Darren will try to get to as many questions as he can during the presentation. If he doesn't get to your question, feel free to email him after the webinar. A copy of the slides can be downloaded from the GoToWebinar dashboard as well. You should see a handout section on that dashboard. The slides are also available on ERISApedia.com. Just click on the Webcasts tab. This webinar is being recorded, and a copy of the webinar will be available on ERISApedia.com Webcast tab in a few days. CE credits will be sent to the email address you registered with. You will receive 2 credits for this 100-minute webinar, but you will need to stay on the line for the 100 minutes to get the certificate. ASPA and NIPA credits will be mailed in a few days. IRPA credits take longer, so please be patient. At the conclusion of the webinar, I will stay on the line for a short demo of Darren's Who's the Employer title on ERISApedia.com. I will also show you how to find information on Harvey and Irma on ERISApedia.com. The demo is voluntary and it will take just a few minutes. And now without further ado, here is Darren.
Greetings and welcome. Thank you so much for joining us. Delighted to have you here. Maureen mentioned the fact that I tell jokes. This is one where there's nothing funny. There really just isn't much you can say that is amusing here, as you're talking about the people who are desperately trying to recover from these disasters. But we're going to go through the procedures that are available and that apply to retirement plans. Overall, there are 3 levels of relief that are available for disaster situations. The first is kind of the garden variety. Most anytime you get a federal declaration of a disaster area, you get the relief under Internal Revenue Code Section 7508A. And it doesn't really get publicized. It was fascinating to me when I started getting into this area how little that component of the relief is known and understood by our community. By contrast, the special IRS relief on hardships and documentation is better announced by the IRS and is more readily known. It makes it to all the various services. In this particular case, for the first time in my recollection, we also have some defined benefit funding relief. So the Presidential Disaster Area Relief, the Code Section 7508A, as I say, happens almost any time you have a disaster. The Special IRS Relief, it has to be up there on the list of problems for the IRS to grant that relief. During the last decade, the 2010s, There have been 4 times they've done so for hardships and documentation, so it's a lot less common. Major congressional relief. There's this entire section of the code, 1400Q, that is devoted to, well, it was Hurricane Katrina. It was focused on Katrina. But in 2008, Congress said, there's been a lot of flooding in the Midwest this year. We really ought to give them the benefit of this relief package too. And they turned on that relief for the people who had suffered under this flooding in 2008. And it's still there in the code. And 2008 proved that Congress can turn it on at will. The question is to do this for Harvey and Irma. The notion of having 2 Cat 4 hurricanes hitting the United States within weeks of each other certainly has got people's attention. I have seen numbers like $275 billion, which in terms of repair costs is just huge. But thank heavens there was not a lot of loss of life. But the kind of relief we can give in the tax system isn't going to deal with the loss of life. It's going to deal with the loss of property. And the property losses that are associated between these two hurricanes are right up there as truly major calamities. So whether we will see Congress give that relief is something that we will see over the coming weeks. But I'll let you know in this presentation what to expect if Congress does decide to turn that on. We begin with the kind of standard package when we have a presidentially declared disaster area that qualifies for individual assistance at FEMA. 7508A says that if there's a taxpayer affected by a federally declared disaster or terrorist or military action, goodness knows we hope we don't have many of those. But so we have a disaster that is a federally declared disaster. The Secretary of the Treasury may specify a period of up to 1 year. Now, yeah, I've highlighted the word may there. So this is discretionary with the IRS. It is not automatic. They need to make an announcement saying we are granting this relief. But they do it every time. They may specify a period of up to 1 year that may be disregarded in determining the timeliness of certain acts and the application of interest and penalties. So the most obvious one, and this makes the headlines, okay? If you're in Houston, you're in Florida, if you're in an area that was designated by FEMA for individual assistance, and you had extended your personal income tax return to October 15, you get an automatic extension to January 31. And, well, that's the timeliness of certain acts, so that's timeliness of filing. But it isn't limited just to filing returns. Revenue Procedure 2007-56 is issued under the authority of Code Section 7508A to say when the IRS gives this discretionary relief when they go forward and decide to do this. Here are the acts that are extended. And it's a huge, long list. The revenue procedure not only says that, it says, here's what we're going to do. In order to turn on this relief, we're going to make a public announcement of some sort. Generally, it's in the form of a news release. In other words, it isn't an announcement that appears in the Internal Revenue Bulletin. You don't have announcement 2017-49. You don't have notice 2017-10. You don't have some kind of announcement that appears in the Internal Revenue Bulletin. But it is a news release, and it appears on their website, and heaven knows Benefits Link and other services pick it up and make mention of the fact. So the IRS turns this on by giving a press release, and within that press release, they will outline both the start and the end of the delay period. So, for example, for Hurricane Irma, for the counties in Florida, the start date was September 4. September 4 was when they started evacuations. So if you had a deadline that was coming up September 5 and you're stuck on the interstate trying to get out of Dodge, you've got an extension outlining the start and end of the delay period. So the start was September 4. The end, in this case, is January 31, 2018. It is the same end for Harvey and for Irma, which makes things really convenient. January 31, 2018. It will specify the affected taxpayers. All right, in general, the affected taxpayers are the folks in counties that have been designated for individual assistance by the Federal Emergency Management Association, by FEMA. But they may expand it. So, for example, we'll come to this in a moment, your business doesn't have to be located in Houston to get the benefit of the 5500 extension for Hurricane Harvey. If you have a service provider who's located in that disaster area, who has records that are necessary for you to complete the return, you also get the extension. So conceivably, you could have a company in Chicago get the benefit of this extension. That's part of this announcement that the IRS puts out. So, and then it will specify the actions postponed, but almost always what it will say is, we're postponing everything that's listed in 2007-56. And then they give a list of the items that can be extended. Let me go to this. This is an excerpt from that particular revenue procedure. This is just the section dealing with employee benefit plans. And as you can see from the screen right now, line 7 is cafeteria plans, for example. It isn't just retirement plans. But the 200 sections, for the most part, are IRAs and similar accounts. But now, once you get down to line 15, you start seeing things relating to retirement plans. And let me just take a moment and scroll here. It's a fairly lengthy list of things that are given extensions under Code Section 7508. 75088, pardon me. And so it gives the code sections or regulation sections or other guidance that applies, and then says, here are the deadlines. Let's just take one. Line 16, sections 401A9, and then a bunch of other code sections. And when you read the guidance, the deadline specifically, the first required minimum distribution from plans subject to the rules in section 401A9 must be made no later than the required beginning date. Subsequent required minimum distributions must be made by the end of the distribution calendar year. So they have specified two deadlines that are associated with 401A9. The first is the required beginning date and everything associated with the required beginning date. The second is the subsequent annual December 31 distribution deadlines. By saying that, by having those two deadlines in that list, they are saying when we, the IRS, give you Code Section 7508A relief, we are extending both of those deadlines. We'll have some examples of that coming up. But that's what's there. Tim, in the materials that are available on the ERISApedia website, do we have a copy of the revenue procedure?
I am not sure if we have a copy of that one. If it's not there, it's going to be added after the webcast.
Excellent. All right. So you can easily see for yourself, and there's a ton of other things there. But that's the section that we in the retirement plan community are dealing with, and as you can see, it's a lot of deadlines. I'm going to go through those in this presentation, and we'll talk about what they mean and give you examples of how you would make use of them. All right, so this is taken from the news release relating to Hurricane Harvey. And the news release for Irma is incredibly similar. In fact, I've been looking at these for a while, and they changed the names, and they changed the dates, and they changed the states, but the news release pretty much stays the same. So here are, I haven't put the entire release here, but here's some of it. The President has declared that a major disaster exists in the state of Texas. Following the disaster declaration for individual assistance, the IRS announced today that affected taxpayers will receive relief. And under 7508A, so they're invoking the authority of the code, the IRS gives taxpayers until January 31, 2018 to file tax returns, and look at the long list, including employment returns, excise tax returns that have an original or extended due date occurring on or after August 23 and before January 31. So anywhere within that time frame, you have an extension for filing a tax return to January 31, 2018. Affected taxpayers that have estimated income tax payments originally due on or after August 23 before January 31 won't be subject to penalties for failure to pay estimated installments so long as you make the installment payments by January 31. So your normal estimate payment is being extended as well. Now, the first paragraph, this is the big one. This is the one that gets ignored by people, and this is the one that's really powerful. The IRS also gives affected taxpayers until January 31, 2018 to perform other time-sensitive acts that are described, well, the regulations don't tell you a lot where it really is, in Revenue Procedure 2007-56. So for us in the retirement plan community, it's that spreadsheet full of deadlines. We give you an extension for all of those deadlines between August 23 and January 31. This relief also includes the filing of Form 5500 returns in the manner described in Section 8, that spreadsheet of the revenue procedure. So there is what is in the news release, and what gets picked up on Benefits Link and a host of other services is, hey, you've got an extension to file Form 5500. The relief goes to any individual whose principal residence is located in a covered disaster area. You know, that's a fairly important point. So one of the items of relief is that loan repayments can be extended. So if I have an outstanding participant loan and there was a payment due August 31, I've got at least the IRS will give me an extension to January 31. The plan doesn't have to, but most of us try to be understanding and sympathetic to employees when something like this hits. I have an extension until January 31 to make that payment. And it doesn't have to be that the employer is located there. If I'm personally in the covered disaster area, I'm entitled to the relief. As far as the IRS is concerned, that August 31 loan repayment is timely if made by January 31. Also, a business entity or sole proprietor whose principal place of business is there. This number 3 fascinates me. An individual who's a relief worker affiliated with a recognized government or philanthropic organization who's assisting in a covered disaster area. So my son, who lives southwest of Dallas, was over in Houston last week helping as part of a church group in an organized effort to take care of people who were dealing with the tragedy. They also get the benefit of this. Proving that may be an interesting issue, but they are entitled to it. An individual whose principal residence or any business entity or sole proprietorship who's not in the covered area, but whose records needed to meet a deadline are maintained in the area. So if your record keeper is in the area, or they're physically located in an area that got flooded out, you get the extension. An estate or trust, spouse of an affected taxpayer with regard to a joint return, it says joint return of the husband and wife. Now that would be joint return of the spouses. It would be gender neutral. Any individual visiting the disaster area who was killed or injured as a result of the disaster, hopefully, well, you know, we had first responders who have been injured in the course of things. If you look at 2017, these are the disasters that have been declared. And there's an easy place to go for it. I've got the web address there. I hate typing web addresses like that. The easy way to find it is to Google tax relief in disaster situations. And once you get past sponsored links, the first thing up there ought to be the IRS webpage. Tax relief in disaster situations. That's where you go. And you'll notice there, at the beginning of the year, there were a lot of storms, tornadoes, and straight line winds in the early part of the year. Notice the extension tends to go 4 or 5 months. And then, of course, towards the latter part of the year, we've got Texas with Harvey, Florida, Puerto Rico, Virgin Islands, and as of this morning, the entire state of Georgia has been added to the list for Hurricane Irma. The start dates with regard to Irma are different in different places. It fascinates me. The start date for Florida is September 4. The start date for the Virgin Islands and Puerto Rico is September 5. And I've got to think this is coinciding with evacuation times, and obviously out in the Caribbean, it hit sooner than with Florida. But with Florida, they started it well in advance. In Georgia, I believe the date is September 7th. So you see the start of the extension and then the end of the extension. As I say, for Texas, for Harvey and Irma, the extension runs out January 31, 2018. In the course of these slides, I'm going to mention Georgia a few times because I want to be able to illustrate some deadlines earlier in the year, like a March 15 or April 15 deadline. So when I mention Georgia, it's to give you an example in the first part of the year. Most of my examples are going to be for Hurricane Harvey. And now we get into the specifics of the relief that is available under 7508A. And I repeat, that relief is for all of these. So if you have somebody who is in the counties, it's not the entire state. If you have a client who's in Arkansas and they were in one of the counties that were affected by tornadoes on April 26th, they're entitled to this relief. Participant loans. It postpones the 5-year deadline and the deadline for making a payment to avoid a deemed distribution. It also ends up extending the cure period. So suppose we have a participant who took a loan in February and they are in the Hurricane Harvey area. They missed their August 31, 2017 payment. I'm going to guess that the employer got flooded out and wasn't making paychecks on time and had it came right at the end of the month. That payment is due January 31, 2018. As far as the IRS is concerned, there will be no deemed distribution so long as the participant makes the payment by January 31, 2018. And the cure period, so if I missed my January 31, 2018 payment, the plan could give me until the last day of the following plan year quarter. All my examples are calendar year plans, unless I say otherwise. The plan could give me until the last day of the following quarter to cure it. So I could have a cure period running until June 30, 2018 before there's a deemed distribution. So the cure period is going to start with that 2018 date. Now, because the 5-year deadline, on repaying loans, wasn't within the hurricane period itself, that deadline is not extended. So the participant still has until February 1, 22 to repay the loan. If the 5-year deadline had come after the hurricane and before January 31, that 5-year deadline would be extended to January 31, 2018. Now, the plan is going to have to decide what it does in terms of administration, how you're going to apply these things. I think procedurally, boy, it would be awfully cold to deny a participant the benefit of these extensions. The premature distribution period. All right, so this is the 10% penalty on taking a distribution before 59 and a half. One of the things that they have there, I can avoid the 10% penalty so long as I take distributions in substantially equal installments over a lengthy period of time. So, and missing installments can mean that the taxes fall on my head. So the deadline to take those installments is postponed. So if I said I was going to take annual installments, and I had an annual installment that would be coming up September 1, 2017, I can take it January 31, 2018. Now, having said that, the next annual installment would still be September 21, 2018. There is, within the IRA rules, an exemption from the penalty tax for first-time homebuyers, which is normally 120 days after distribution. So suppose an IRA owner takes $50,000 from an IRA and says, I'm going to use this money as down payment for a new home. The deadline to acquire the home was, that 120-day deadline, was October 1, 2017. Let's suppose that home they don't want to buy anymore. That home is one of the ones that got destroyed by the hurricanes. They have until January 31, 2018 to do one of two things. One, close on another property, or two, roll it back into an IRA. So they have the ability to avoid the tax altogether, put it back in the IRA, if that's what makes sense under the circumstances. Qualified reservist distributions, so these are distributions to folks called up in the Army Reserves, the National Guard service, and it has to be for an extended period of time. If memory serves me, it's something like at least 179 days or indefinitely. If you take a qualified reservist distribution, you have 2 years after active duty ends to repay the distribution to an IRA. Now, this is an after-tax contribution. You don't get a deduction for putting it back in the IRA, but still, it's back in your savings, and it is earning money on a tax-deferred basis. Well, that 2-year period to repay the distribution is extended if the normal deadline fell within the hurricane relief period. So Joe was called up to active duty in the National Guard. January 1, 2015, and it was for the required period of time. He took a $30,000 qualified reservist distribution from the plan. His active duty ended October 1, 2015. Well, had there not been a hurricane, his 2-year deadline to put the money in an IRA would have fallen October 1, 2017. That gets extended to January 31, 2018. The normal deadline for IRA contributions is April 15. Well, a person in the counties in Georgia affected by the tornadoes would have until May 31, 2017 to make their annual IRA contributions. This also affects rollovers. So, for example, suppose a plan makes a distribution to a participant July 15, 2017, for those of you who don't speak flub. The plan distributes to the participant in July. They have 60 days to roll it over. The normal rollover deadline is September 13. It got extended to January 31. And that would be rollover to a qualified plan, rollover to an IRA. Now, if I am the capital P, capital A plan administrator of a retirement plan, and somebody says, I took this distribution from my old employer back in July, and I want to roll it over to your plan. I was a victim of Harvey, and so I have until January 31, 2018. I would want some, at the very least, assurances from the participant. Okay, where were you living? Why are you entitled to this relief? And you say, well, I lived in Houston on that day. I've now moved somewhere else, but I lived in Houston. I would want to have that in the file just to show that you've done your diligence in making sure that the participant is entitled to do the rollover. Required minimum distributions, as we said, extends both the required beginning date and subsequent distribution dates. So suppose a plan is required to pay out a $10,000 RMD by December 31, 2017. It is timely if made by January 31, 2018. Now notice what that's going to do to this person. That's going, waiting the month, is going to reduce their taxes for 2017, but increase their taxes for 2018 for a few taxpayers, not many, because they will have 2 RMDs in 2018 that might push them to a higher tax bracket. And if it does, they may prefer the distribution in 2017. But there's one other note here on the screen. The January 31, 2018 RMD will be a little higher. That's because the 2018 RMD is going to be based on the account balance as of December 31, 2017. Well, you haven't taken out that RMD. So the RMD that will come out in 2018 may be something like $400, $500 higher because you didn't take out the RMD, December 31, $10,000 RMD, December 31, 2017. Excess deferrals. You know, this is, the IRS gets it right. I want to go back and look at the listing here. Look at line 19, 401A30. Excess deferrals plus the income must be distributed before the first April 15 following the calendar year. Now skip down to line 24. 402G, an individual with excess deferrals must notify the plan not later than a specified date that the excess deferrals have been contributed. A distribution must be accomplished no later than April 15 of the year following. There are actually three different deadlines that are involved and that are being extended. And this is a subtle point. The IRS gets it right here. They handle what they're supposed to handle. They take care of the whole area. But it's important to see how this works. 402G is a personal limit. It's a limit on me. I'm catch-up eligible. I can't defer more than $24,000. And that includes any plan in which I may be a participant. So I begin the year working for a law firm and I contribute $15,000 to their 401k plan, and then I move and I go teach law school somewhere and I participate in their 403b plan and I contribute $15,000 there. I'm over the limit because it's a personal limit. I cannot exclude from my income more than that amount. All right. Neither the law firm nor the law school is going to know that I went over the limit. Each of them says, well, he only deferred $15,000. He's good. They're not going to know unless I tell them. And if I don't tell them and say, please, please, please give me back $6,000, I have to tell that to one or the other. So I get under $24,000. Unless I do that and get that $6,000 by April 15, I end up paying a double tax on that amount. This extends that April 15 deadline, but it subtly also extends another deadline as well. Again, go back to line 24. An individual with excess deferrals must notify a plan not later than a specified date following the taxable year. So you have a plan document, and it's written by somebody who's looking after the interest of the plan. We haven't done anything wrong here, all right? You only deferred $15,000 to us. If you want us to cut your check by April 15, we want you to let us know by, pick a date, all right? But it's probably in the document. So I've seen documents that say you have to let us know by March 1, or you have to let us know by March 15. It could be you have to let us know a reasonable time before April 15, in which case that gives you some wiggle room. But because they put that deadline in there, the deadline to notify the plan, the IRS is good. The plan may not be good, but the IRS is good with you telling the plan after the deadline. So I'm in, I was affected by the Georgia tornadoes. So remember, that gives me an extension until May 31. I could go to the plan, let's say May 1, and say, oh my goodness, I've got this problem. I need $6,000 back. And the plan says, well, the document says you should have let us know by March 1. And I say, yeah, but I had this tornado and my house blew down and I'm still trying to get my life back together. And the IRS says you can extend the date. They won't hit you for an operational failure in extending the date. Give me a break, because I don't want to pay double tax. Boy, that would be a really hard argument to say, no, I don't want to do this. So the plan says, all right, we'll waive our date and we'll cut you that check by May 31. All right, so that's all good. What's line 19 about? Line 24, 402G itself, is about the participant. It's about the double tax that the participant pays if they don't fix this. 401A30 is an instruction to the plan. 401A30 tells the plan, thou shalt not allow a participant to contribute more than $30,000, pardon me, more than $24,000 in the course of a year. And so that gives you the opportunity to fix it. Because the plan, from the plan's perspective, if the plan, so now let's get rid of, I had two plans. Let's just have one plan, and folks are asleep at the switch, and they let me contribute $30,000 to the plan for the year. Not only do I have a problem, potential double tax, but the plan has a qualification failure. The way the plan fixes the qualification failure is they make the distribution by April 15. Well, if they don't make the distribution by April 15, they can still fix the qualification failure by making the distribution under EPCRS, but I still face the double tax. Oh, and by the way, if they're distributing under EPCRS, they have to include income up to the date of distribution, which you don't do if you're making the distribution on time. Well, on time for the victims of the Georgia hurricanes was extended to May 31, 2018. So it extends the deadline both for the participant and for the plan.
Darren?
Yeah.
I've got a question on the plan document. I just heard something that shocked me a little bit in that you just said, I think you just said, that when it comes to the period by which a person must notify the plan that there's an excess, that you don't have to pay any attention to the rules in the document.
I think that the extensions here would give you relief from an IRS standpoint for failure for the operational failure. Now, can the plan say, I don't care if we have that relief, we're going to insist on the terms of the plan? Absolutely. But in terms of the IRS, I think that extension gives you relief from the potential operational failure for failure to follow that particular procedural requirement.
And then a follow-up question. So does that work for anything else? Let's say that the plan document is silent on any of these issues. There are not any special rules that say that a loan can go longer or any of the other things you've been talking about. In that case, can you just not follow the terms of the plan?
I think you get the benefit of the relief, yes. In other words, as far as the IRS is concerned, you don't have a document failure pardon me, an operational failure arising from failure to follow those terms, I will add the DOL has said we are not going to hit you for a Title I failure for failure to abide by the terms to the extent that you have that relief. So both Title I and the operational failure issues, I think, are handled by this extension. So let's go back for a moment to the required minimum distribution deadline. You've got a document that says very plainly the deadline to make that distribution is December 31, 2017. And I am making the distribution January 31, 2018. I don't think I have an operational failure, and I don't think I need to amend the plan to allow for the January 31, 2018 provision. I don't think it's the type of event that requires a discretionary amendment. I made it late, and the IRS permits it, and life goes on.
Interesting. Thank you very much. I appreciate that.
Surely. All right. That's not the only corrective distribution a plan might make. So we also have ADP, ACP corrections, and we've got two different deadlines there. The first is the March 15 deadline for a calendar year plan to distribute without a 10% penalty tax. So I've got a plan in Georgia, and they were affected by the tornadoes. They want to correct by refunding excess contributions to the Hileys. They would have until May 31 to do so without incurring a 10% penalty. The other deadline is a 12-month deadline to maintain the qualified status of the plan. If you don't distribute the excess contributions to the Hileys by December 31, again talking about a calendar year plan, it is an operational failure, and you now find yourself in EPCRS for dealing with the corrections. And EPCRS is a lot less kind to you on correcting ADP, ACP failures than are the normal rules. My hands are tied in several important respects if I am correcting under EPCRS. For example, I can just give the money back to the Hileys plus, I can give the money back to the Hileys anytime up to December 31. Yeah, I'm going to have to pay a 10% penalty, but there's nothing else that I have to do if I get it in by December 31. But after that date, not only do I have to give the money to the Hileys, I also have to put in a QNEC for the non-Hileys once I find myself under EPCRS. Well, that 12-month deadline to fix things is also extended. So if I've got a calendar year plan, they're in the Hurricane Irma area, and they are looking at a December 31 12-month deadline, that's extended to January 31, 2018. Interestingly enough, and I have gone through that list 5 times looking for this, and it just isn't there, it does not extend the deadline to make a qualified matching contribution or qualified non-elective contribution to fix the failure. So if instead of returning money to the Hileys, the employer decides, I want to make a QNEC for the non-Hileys and raise them up so I can leave the Hileys money alone, you're sitting there at the normal 12-month deadline to put that in. There is no extension of that. The remedial amendment period under Code Section 401B is extended. the IRS has never said that this extends the deadline for discretionary amendments, interim amendments, restatements. Or for that matter, as far as I can tell, if it comes up, the 403B remedial amendment period, which runs out March 31, 2020. One of the things about the revenue procedure is it came in place before we were really well into our current regime of discretionary and interim amendments, although to some extent those were in place in 2005, but they really kicked into gear in mid-2007. About the time they were drafting the revenue procedure, they weren't put in there. If you've got, all right, so let's suppose I have a company that decided to add a Roth feature to a plan. And they've already been implementing the Roth feature and said, oh, we can wait to sign the amendment until December 31, and we like procrastinating, so we'll wait a bit on signing the amendment, the discretionary amendment. The deadline to sign the discretionary amendment is December 31, 2017. They don't get a January 31 extension. Now, notwithstanding that, if I had a client that missed the December 31 date, that didn't do it until January 31, but they got it in within the period, I would be real tempted to argue with any auditor that I really ought to have the benefit of that extension. I'm not sure that the auditor would really understand the limits to what the IRS has done. But I would think, just as a human matter, they would be hard pressed to say, no, I'm gonna put you an audit cap. You get a sanction here. But my suggestion is, right now, with the wording that we have, I would treat the normal deadlines as in effect. All right, we know that the deadline to do your taxes is extended. So the deadline to do the corporate tax return or the partnership tax return is extended. And so let's say we've got a calendar year corporation and their return was under extension. Well, that due date has been moved to January 31, 2018. Well, the deadline for the employer to make contributions for 2016 and deduct them on the 2016 return is the extended due date of the 2016 return. So extending the due date of that return extends the deadline for you to deduct those contributions. Now, that particular point is specifically mentioned in the revenue procedure, but there's another one that flows from it automatically. It isn't mentioned on the revenue procedure, but it comes along for the ride. Your deadline to have it be a 2016, annual addition for the 415 limit is 30 days after the extended due date. So moving the extended due date moves the 415 annual addition deadline. So to have it be an annual addition for 2016, I think you get until February 14, 2018. Pardon me, not February 14. Let me say March 2. That would be 30 days after January 31. So March 2, 2018. But, and this, somebody asked me about this, and I researched it, and it's right. As far as I can tell, there are no extensions of anything related to the ADP ACP safe harbors per se. So I have an employer that wants to set up a new safe harbor 401k plan with a calendar year, and it is not a successor plan. The employer's been around for a while, but we're going to put in a new plan. They haven't had a 401k plan. They want to have a new plan, and they want it to be a safe harbor plan. The deadline to do that is 3 months before the end of the year. So October 1 is your drop dead date to do that. That date is not extended. So suppose I have a calendar year safe harbor plan for 2016. The deadline to make the safe harbor contribution for 2016 is December 31, 2017. That date has not been extended. I find this truly bizarre. Suppose I have a safe harbor 401k plan with a 3% safe harbor non-elective and a cross-tested profit sharing contribution, discretionary, on top of that. The deadline to make and deduct the 2016 discretionary profit sharing contribution is January 31, 2018. But the deadline to put in the 3% non-elective is still December 31, 2017. I think this is a mistake. I think, if pointed out to the IRS, they would say, oh my golly, this is something we need to fix. But as far as I know, it hasn't been pointed out. And we have the safe harbor regs in 2004. There's really no excuse for it, but there it is. The deadline to provide your safe harbor notice, your YACA, QACA notices, all of those is December 2 for a calendar year plan. But that is the deadline for it to be deemed reasonable. It has to be given a reasonable time before the beginning of the year. Well, if I have a company whose offices and facilities were wiped out in Hurricane Irma and they're still trying to recover, and they've got people on furlough, you would, I think, have a receptive audience as you argue, yeah, in this case, December 20 was reasonable. So I'm not as concerned about the December 2 deadline as I might be. But suppose I'm going with the maybe notice. I gave a safe harbor notice before the beginning of the 2017 plan year and said, right now we're not safe harbor. We're an ADP tested plan, but we want to leave the door open and maybe we'll make a 3% non-elective contribution for you. If we decide to do that, we'll let you know. And it will be effective for the whole plan year. The absolute drop-dead deadline to give that supplemental notice for calendar year plan is December 1, to have it be effective for the 2017 plan year. It would be December 1, 2017. That deadline is not extended. And we have one more deadline that has come up. And this relates to a mid-year amendment of a safe harbor plan. If you have a mid-year amendment of the safe harbor plan, and you can amend almost anything, but if you change what is in the safe harbor notice, you have to give people notice and an opportunity to change their deferral elections. And ideally, you give them this notice before the amendment goes into effect, but that isn't always practical. And so the IRS puts an absolute deadline of 30 days after the amendment is adopted to provide that notice. As far as I can tell, that 30-day deadline is not extended. Going back to the IRA world, let's get this over. There's really a wonderful gift in the IRA world. It's called recharacterization. If I move money from, if I put money into a conventional IRA, I can recharacterize it as Roth within a certain period of time, or vice versa. So let's say I have $100,000 of pre-tax money in a qualified plan, and I take a distribution of that money and I roll it into a Roth IRA. So I'm committing myself to pay taxes on $100,000 on that rollover. Oh, let's say the rollover, well, I have the example, a $30,000 pre-tax distribution April 15, 2016 from a 403B plan. And it was a direct rollover to a Roth IRA. Let's suppose they come to now in 2017, and Sue looks at her Roth IRA and she finds there's only $25,000. In other words, she's lost money on her investments. And she sits back and kicks herself because here I'm going to have to pay tax on $30,000 on money that's now only worth $25,000. This wonderful technique called recharacterization lets her take it out of the Roth IRA, move it to a conventional IRA, and treat it like it was in the conventional IRA all the time. So she avoids paying the tax on the conversion. But her deadline to do that is October 15, 2017. If she's affected by Harvey or Irma, she has until January 31, 2018 to make that decision. Oh, and by the way, the following year, she can move it back to the Roth, but now only paying tax on $25,000. The deadline to return non-deductible contributions to avoid the 10% penalty is the deduction deadline. The disaster relief extends both the deduction deadline and the deadline to return the contributions. It also extends the deadline to file Form 4975. That deadline differs depending on the tax involved. Now, the 5500 is extended, and they have never ever mentioned 8955 SSA. Well, the SSA didn't exist at the time. The revenue procedure came up. I believe, and I would be shocked if there would be something different, but I honestly believe that the 5500 extension is also an 8955 extension. And there is a checkbox there to say, I have a disaster, I'm entitled to relief, and it's the same checkbox you have on the 5500. I would put the same answer, Hurricane Irma, there that I put in the 5500. The statement that is in the revenue procedure, in the case of affected taxpayers, all right, well, we talked about the definition of affected taxpayers earlier. So folks that are in the disaster area. The IRS may permit a postponement of the filing of 5500 or EZ. Taxpayers who are unable to obtain on a timely basis information necessary for completing the forms from a financial institution or service provider, because the service providers in the covered disaster area will also be treated as an affected taxpayer. So we have this specific section for Form 5500. So if you've got a financial services firm that's in Jacksonville, you would have, as their principal office, you have this automatic extension of your 5500, even if your company is in California. They also note that DOL PBGC always accede to the grant of relief. So it is not only the IRS 5500 deadline, it is also the DOL and PBGC corresponding deadlines. That's part of the process.
Darren,
yeah.
Question on that last slide. Interesting situation where the plan might be in Oregon, but the third-party administrator is in Florida. That serves to help them on the 5500 deadline. Does it help them on any of the other items that you've been talking about?
No, it's just the 5500 deadline. So, okay. For example, the deadline to make ADP ACP corrections would be the normal deadlines. It is only for the 5500 that they mention this.
Okay, so if the third-party administrator doesn't have an office and the deadline's coming, the plan's out of luck, they have to find someone else to do the test.
You know, let's go back. Let's make sure of this.
Okay.
Who gets the relief? Who's an affected taxpayer? The bullet number 4. A business entity whose principal place of business is not in the covered disaster area, but whose records necessary to meet the deadline are maintained in a covered disaster area. I think that would be the one you'd use. So that would be the, now that I think about it, that would be the one for the TPA in Florida.
So for those people that are on the call who have a business office in any of the affected areas, their plans basically get the benefit of these rules.
Well, the records are maintained in a covered disaster area. So if your principal business is there, yes. Now, if I've got offices in 5 different states and one of them happens to be Florida, forget it. But okay. If the records are maintained there, yeah. So my place of business is there, and all my computer records were destroyed in the course of things. Yeah, my customers get the benefit of it. They become affected taxpayers as well.
Okay, and then one other similar question. You have a plan, and the plan covers people who work in 2 different states. One of the states is Florida, the other state is Oregon again. Does the benefit of these rules go to the plan as a whole, or only to those people who are working in the area that's been affected?
Well, in terms of the loan repayment, it would be where the individual is. In terms of the RMDs, I would base it on whether the plan itself is an affected taxpayer. So if and there it's a matter of where are the records being kept, what's your principal office.
Okay. Thank you.
FCRS, the 7508A relief extends the deadline for correcting significant operational failures. Normally it's a 2-year deadline. It fixes that or extends that. It also extends the 1-year deadline that applies after a merger or acquisition. with respect to assets, the plan assets that come to me in the course of the merger. I have 1 year after the merger to find and fix significant operational mistakes, if that would be after the normal 2-year deadline. This extends that deadline, but it doesn't. In recent years, 2015, I believe, the IRS very graciously gave us some reduced correction costs to fix missed deferrals if you caught it early in the process, and particularly if we're dealing with an automatic enrollment plan. So I have an automatic enrollment plan, and I missed somebody who should have been automatically enrolled. I missed them in 2018. I have until October 15, 2017 to find it and fix it, and I don't have to deposit anything at all to handle the missed deferrals. I have to handle the mismatch, but the fix of the missed deferrals is free. I think that deadline is still there. And you know, they have it adjusted for that. All of this is an argument, gee, they need to update the relief. Turning to the Department of Labor, they take their time to do this. If you want to find their page, the easiest way to find it, well, one, you can find it on their homepage, dol.gov/EBSA. But if you Google DOL EBSA Compliance Disaster Relief, you'll find a list of disasters and the relief given. The overall instruction is, all right, you're in a bind. We understand that. Your general rule is act reasonably, prudently, and in the interest of your employees to comply with the rules as soon as practical. They are not going to enforce Title I for late deposit of deferrals and loans. So if you had a small employer and you had the August 15 paycheck and your normal deadline, given the fact that there's a weekend to deposit it, would have been after August 23. You have an extension. It isn't until January 31, 2018. Comply as soon as practical under the circumstances. But we're not going to hit you with a penalty because you were affected by the hurricane. There's also an extension. All right. So suppose because of the hurricane, our website closes down, you're not going to be able to make trades, you're not going to be able to get loans, and it's going to take a while to figure it out. That's technically a blackout. And normally you have to give a blackout notice 30 days before the blackout occurs. Well, if it's a disaster situation, you don't, obviously, there's no way to give the blackout notice 30 days before it occurs. You don't know. But you put a note in the file saying, we weren't able to give the notice on time because of this. You, the administrator, make a finding that you had just cause for this delay, and you write a note about it and put in the file. You're excused from writing the note. The DOL has written the note for you. Isn't that sweet of them? The PBG, but the key point for their relief is they're not going to treat you as having a Title I failure because you're late on some things, or because you're late on the things that the IRS is giving you extension on. The PBGC delays a bunch of their deadlines for people in the disaster area. This is standard. It happens with every disaster. You know, it's part of their own version of Code Section 7508A. They give you extensions on a bunch of deadlines to essentially the same date the IRS puts out. So it's January 31 for Harvey and Irma victims. So it gives you a deadline for premium filings, for example. But they also say, we realize this isn't everything that might come up. So if you have some other situation that you think needs relief, give us a call and we'll talk about it. So that's where they are. That's the stuff that happens anytime you have a disaster area and the IRS gives the notice. All these things get triggered. But in a few cases, the IRS has gone beyond that. Here is the list of the situations where they have given special relief relating to loans and hardship distributions. Katrina was the first time, and look at the gap. They didn't touch it again until Sandy. And since then, we've had Louisiana flooding and Hurricane Matthew last year, Harvey and Irma this year. So this is not something that happens all the time. It has to be a fairly major disaster. But the relief they give is cookie cutter. They have the announcement written, and it substitutes the disaster and substitute the dates, but it is the same relief every time. The individuals who are entitled to relief are broader than the affected individuals that you see with the 7508A relief. Any employee or former employee, so I've got money in this plan, even though I no longer work there, I could be entitled to it, whose primary home or place of work was in the disaster area, or who had a spouse or a descendant or an ancestor whose primary home or place of work was in the disaster area. So I'm in California. Suppose I have a son in Houston. I'm entitled to the relief. I have a grandson in Houston. I have a mother in Jacksonville. I'm entitled to relief under this provision. The relief relating to hardship distributions this is a hardship. The hurricane itself and being an affected taxpayer, including having a kid in the area, is automatically a hardship. So plans that can make hardship distributions can make distributions on account of that. So I can get from a plan that can allow a hardship distribution, I can get a hardship distribution which I would use to take care of my son in Houston. This is not only qualified plans and 403B plans which make hardship distributions, it is also governmental 457B plans which make distributions on account of unforeseeable emergencies. This is true whether or not the plan at the time of the distribution has hardship language or recognizes this particular hardship. So suppose the plan document says, we'll give you a distribution for a casualty loss for your principal residence. But if your wife and kids and parents have a casualty loss, that's too bad. But we will give you a casualty loss to your principal residence As far as the IRS is concerned, we don't have a qualification failure. As far as the DOL is concerned, we don't have an ERISA failure if the plan says we're going to treat this as a hardship anyway and allow you to do it. Now, if you don't have hardship language in the plan, in order to validate these distributions, the employer has to turn on hardship distributions by the last day of the 2018 plan year. So this is a year longer than you would normally have to make that discretionary amendment. You can now, this only works for a plan that can normally make hardship distributions. So a pension plan can't make hardship distributions. I can't make hardship distributions from safe harbor contributions. All those rules are still there. But for a 401k plan, not from safe harbor contributions, not from earnings on deferrals, we can make the hardship distributions. We can rely on the employee's reasonable representations, both on the need and the amount. So the employee says, my son is in Houston. That's it. All right? Put it in writing so you have it for the file. And the employee says, I need $40,000 to take care of my kid. That's it. You make a note of it for the file. Moreover, there is no need to suspend deferrals for 6 months. So it is very generous.
Darren,
Tim, do you have something there? Yeah.
Yes. I've been getting some questions on this, and a couple things with the hardship. Number one, the person who takes a hardship is 40 years old. Is there still an excise tax?
You bet. So there's normal income tax and a 10% penalty tax.
Okay, and then the other rule for getting a hardship is that if the plan has a loan feature, that you have to take the loan first. Does that rule still come into play?
You know, they didn't waive that one from your deferral account. I don't see that they waived that one.
Okay.
They waived, that's part of the 6-month deferral suspension. In other words, it's in the same section. And they waived the 6-month deferral suspension, but I don't think they waived the take loans before you take hardship distributions rule.
Okay. Thank you.
You don't have to necessarily follow all plan procedures, and this applies to both loans and distributions. It's more than just hardship distributions. So, for example, if you have a distribution where you need spousal consent, and you say, my spouse can't consent because we can't locate her. She was in the area, and as far as I know, she's passed away, but we can't locate her. You don't have to wait for a death certificate. You get your paperwork handled as soon as practical, but go ahead and relieve the needs. So this applies to all distributions and loans. And we've already talked about, so you can make loans if necessary to deal with these things and turn on your loan provision by the last day of the 2018 plan year. I don't need to add special Harvey or Irma language to the plan. I just have to turn on the hardship and loan features, which is generally a checkbox in your pre-approved document. We have never, to my knowledge, had an extension of deadlines for defined benefit funding relief. For the first time, we've gotten that extension. It's notice 2017-49. And the affected taxpayers are interesting. You asked the question about the company in Florida and in Oregon. Well, if it's a single employer, the question is the principal place of business in Florida? If it is multiple employers, and for this is interesting to me because I deal with controlled groups. If there are multiple employers, I disregard the controlled group rules. So if I have a brother-sister controlled group and I've got a company in Florida and a company in Oregon, and for most purposes, they're treated as a single employer. For purposes of the funding relief, they're two different employers. If they are two employers, the question is not where's the principal place of business. The question is where do the employees work? And if more than half of them are in Florida or in the Irma disaster area, you get the benefit of it. It also includes the office of the plan or the plan administrator. So even if the bulk of the employees are in Oregon, but the office is in Florida, you'd get the benefit of this. The office of the primary record keeper or the enrolled actuary or other advisor. So I have already retained, I can't go out and hire a new one to take advantage of this. I've already retained an actuary in Jacksonville. I get the benefit of this extension. And it extends the deadline to the 8.5-month deadline to make your minimum required distribution. It extends the deadline to put in quarterly installments. It extends the deadline for certification of the AFTAP. It extends the deadline to ask for a waiver of the deadline. It extends the deadline to give employee notices. It extends to PBGC deadlines that are associated with the timeliness of contributions. All of those get extended. And if you're dealing with a defined benefit plan, it's Notice 2017-49. There are separate deadlines for single employer plans, multi-employer plans, CSEC plans. They're all outlined there, and I think they did a pretty thorough job of handling the defined benefit arena. So now we just need to get one of those for Safe Harbor 401k plans. That's the relief that we have thus far. Now, and I'm not going to go through all the details here because we don't have this yet. But with Katrina, we got some fairly significant relief out of Congress. And let me just quickly go through. I'm not going to do the details. You can read the slides to get the details. But I want to go through the type of relief that, boy, it's a really short provision to turn this on. As I say, this is section 1400Q of the code. And it was written for Katrina, Rita, and Wilma, but it was applied to storms in the Midwest and flooding in the Midwest in 2008. You're talking about it in terms of the hurricanes in 2005. The beneficiaries are those with their principal place of abode in the affected states, or who sustained an economic loss by reason of Hurricane Katrina. Notice this one is not your kids live in the area, which is why I say the IRS is broader than the statute. But these are people who themselves live in the area. They came up with a new concept, a qualified Hurricane Katrina distribution that allowed you to take 100,000 from the date of the hurricane through the last day of the following year, and it could be any distribution you like. It doesn't have to be a specific hardship type distribution. So it could be an RMD. It's not a corrective distribution, but just about anything there. And from the participant's perspective, there's no 10% penalty. So if I take a Hurricane Katrina distribution, there would be no 10% penalty if I'm under 59 and a half. That's what has to happen to avoid the 10% penalty tax on hardship distributions, is Congress needs to turn on this relief for these folks. There's a fascinating page on Wikipedia listing serious disasters affecting the United States. Most of them are in the distant past. There aren't that many in the last 60 years. And the way they define significant is there were at least 400 casualties. Harvey and Irma aren't going to be on the list, thank you, kind heaven, because we didn't have 400 casualties between them. But the economic loss is bigger than anything other than 9/11. But other than 9/11, the biggest one in terms of loss of life within the last 60 years was Hurricane Katrina. And that may be why there was the impetus to give that relief there. But as I say, in terms of property damage, the damage estimates I'm hearing for Harvey and Irma way exceed the damage numbers I saw for Katrina. And that's, what these distributions can help with is the economic losses. So from the recipient standpoint, there's no 10% penalty. You have the option to pay your taxes over 3 years and the option to roll it over. From the plan standpoint, it was automatically a distributable event, but it was not treated as an eligible rollover distribution, even though there was a rollover option. So you don't have to give a rollover notice. There was no 20% withholding automatic. These next slides go through some of the specifics on that, and how you would pay the tax over 3 years. I find this fascinating. You have the option to roll over a Katrina distribution just like a 60-day rollover. And if you did so, you don't pay tax on the distribution. So I could get a refund. If I was using the 3-year option, I could get a refund of the taxes that I've already paid if I put it in within 3 years. And I could roll over a hardship. The plan had the choice whether or not to recognize Katrina distributions. They could treat it as a distributable event. The plan was entitled to rely on the individual's representations, but wait, there's more. There was not just the ability to get that $100,000 distribution. They doubled the loan limits. The loan limits under 72P were the lesser of 100,000 or 100% of the invested account balance. Moreover, there was suspension of loan repayment period, and the 5-year clock runs during that period. They also gave you a rollover period to deal with distributions that were going to be used to purchase a new home, and an extended period to do that. None of that is there right now. And it's right there in the code waiting to be turned on by Congress if they decide to do so. But very significantly, they didn't do it with Sandy, which was a very expensive issue affecting a lot of people. They didn't give that relief with Sandy. We'll see if they give it with Harvey and Irma. But the level of relief that is already there from the agencies, from the IRS, from the DOL, from the PBGC is outstanding. I am not seeing any questions from the audience on the screen. If you have them, send them into us, and I'll try and answer them. But
Darren, I actually can see the questions, and I don't know why you can't, and I apologize for that. We have answered quite a few of them. I've tried to sprinkle them in the right part of the
Thank you.
Webcast.
Do you have another one you want to give me?
Let's see. I think we've covered pretty much all of them. We have a question about Puerto Rico plans. 5500 filing.
They also have the benefit of this. Yeah.
Okay. Okay, so that's really just
and it is specific municipalities in Puerto Rico that there's a specific IRS notice for Puerto Rico. It isn't the whole island. It is the specific municipalities that are listed there. Similarly, it is specific islands in the U.S. Virgin Islands.
Okay, and since Puerto Rico is only subject to Title I DOL rules, any of the tax rules that we're talking about would really only come into play if the Puerto Rico tax, I think it's called the Hacienda, issued their rules on the tax side.
Correct. However, you do have Puerto Rican plans that are dual qualified, that both have Puerto Rican status and have status under the federal rules, and we have here a waiver of the federal rules. You'll have to look to the Hacienda for the waiver of the local rules.
Okay. Let's see. I think, okay, I guess...
Wouldn't, if you think about it, if you were going to have someone come by and talk to you about your taxes, would you rather have someone from the IRS or from the Hacienda? I love the sound of that. It sounds so friendly and mi casa es su casa.
Right, and I used to, when I was practicing law, I had several clients down in Puerto Rico that were dual qualified, and the Hacienda seems to take a little less rigid sort of an approach to things. So I think I'd rather be judged by the by those folks in our IRS. Question about the hardship.
Yeah.
Where you said that basically the fact that you're in one of these zones constitutes a hardship. What other documentation is necessary? Do they have to prove that it went to fixing their car or fixing their roof or something like that?
That's the great thing. No, you don't have to prove any of that. So the fact that my kid, my mother was residing or working in the area is enough. So suppose my son lost his job because his company was wiped out in the area, and I want to give him some money to buy groceries and pay the rent while he looks for a new job. All I have to say is, I have a kid who's in Houston, and I have a hardship. Nothing further is required.
Okay. Question on hardship, and this is one that I even know the answer to, but I'll give it to you anyway, Darren. If you add a hardship for purposes of letting people get money out, can you then turn it off in the future?
And the answer is?
Yes.
Go ahead.
Yes.
Absolutely, it's not a benefit right or feature. And there's a specific provision in the regs that lets you turn hardships on and off, so long as it's not in a discriminatory manner. We're going to turn it on, let the HCEs take care of their needs, and quickly turn it off so that the non-highlies are desperate and have to work harder and faster because they can't get money. You know, if this is the Simon Legree plan, that would be considered a discriminatory amendment. But other than that really bizarre case, yes, you could turn them on and off.
Okay. Let's see. Let's see. And I got a lot of questions about doing amendments to plans, like changing the maximum number of loans from 2 to 3, and that sort of thing. I would assume that the normal rules for doing a plan amendment would apply in that situation.
All right. Hardship and loan provisions, that particular one, I would say, I think you've got a pretty good case that you have the 12 months after the end of the plan year deadline to extend the maximum number of loans if you wanted to do that. I would put that in the same category as turning loans on. But the fact that your first thought is to go in the other direction says to me, if you can do it by the end of the year, do it. But if you don't get it done by the end of the year, I'd feel really comfortable myself arguing that's in the nature of turning loans on and off for a given participant. Okay.
So we got a second question on the loans. It's clear to you that if the plan offers loans and a hardship, that you still have to take the loan first.
That's my take. All right? You've been looking at this. Do you have a different take? That's mine.
No.
I can't see where the IRS has granted any relief on that point.
Right,
and the fact that they deal with one clause in the safe harbor hardship provisions and don't deal with the other one, since the other one is still in full force and effect.
Yeah, and I think that's a good way of looking at it. These rules really overlay everything else that comes into play. So you still have to follow every other rule unless the IRS specifically says you don't have to follow this rule.
Yeah. Yeah. If well stated.
Okay. And then we're having a little chat here with someone, but the loan will make so let's say that making a loan will make the hardship worse. I guess that's still the rule that comes into play, that you don't have to take the loan if it makes a hardship worse. But
okay, now the question is, all right, now you're going to hear the tough side of Darren Watson, because I have a stricter interpretation of that than many people do. If you read the regs, they give one example of making the hardship worse. The one example they give is, I want to get a loan to buy a home, and I actually had this happen to me. For my first home, I had a family trust that was going to loan me the money for the down payment. And I went to the bank to get a mortgage, and they say, where are you getting the money from the down payment? And I said, well, a family trust is going to loan me the money. And they said, you said the magic word, loan. If the money for the down is being loaned to you, we won't give you a first. And so I had to get it as a distribution from the trust rather than as a loan, and they said, okay, now we will give you the mortgage. So it's the same type of deal with regard to a plan. If you're borrowing the money, if that keeps you from getting the distribution from the bank, that makes the amount of money you need to have to purchase the home greater. It increases the amount of the hardship. Well, suppose I have a situation where I need to come up with money to pay my son's tuition, and that's my hardship. Whether I take it as a loan or whether I take it as a distribution doesn't change the amount of my son's tuition. It doesn't increase the amount of the hardship. And assuming you're dealing with the safe harbor hardship needs, the fact that I have to have more of my pay go to pay my participant loans means I might have some trouble paying my Visa bill. But that isn't a hardship that the plan can deal with. Now, having said all that, so Darren Watson is negative on ignoring the loan provision. Putting that aside, I think one would have a better chance to make the argument in this case where it's, oh, my kid lives in the disaster area, I need it. I still don't like that provision, and I feel really uncomfortable using it. So I tend to be very negative here.
Okay. Well, I think we've gone over our time. Darren, thank you so much. This has been very, very helpful. It's interesting. We started out with 720 people. We have 711 still on. So I think that's a record for people staying on. And congratulations to you, Darren, for a great one.
Thank you so much. And Maureen, yeah. I think we're back to you.
All right, sounds good. Thank you, Darren, and thank everyone for attending. Remember, you can download a copy of the slides from this presentation directly from the GoToWebinar dashboard under Handouts or from ErissaPedia.com's website, the webcast tab. And we're going to stay online here for a little bit so I can show you where to find the information about Harvey and Irma on ErissaPedia.com, and I'm also going to spend a couple minutes just showing you Darren's Who's the Employer e-source, so we'll be back shortly. Okay, let's just get started on the demo quickly. I will show you where to find the information about the recent hurricanes. Under the IRS Other section of ErissaPedia.com, you'll find announcements and notices. Under announcements, I believe it's the last two announcements. The second to the last one deals with Harvey, the last one with Irma. And under notices, you will find the information under the last two as well. Darren also, in his presentation, he referenced a revenue procedure. It was 2007-56, the Disaster Relief Overall Guidance. On our web, on ErissaPedia.com, you can find that quickly. And if you click on Section 8 here, Employee Benefit Issues, it will bring up the chart that he was referring to in his session. All right, let's talk about Darren's book quickly. Who's the Employer eSource is a 25-chapter book with an introduction as well as an appendix. The appendix, as you can see, has some great supplementary information and tables like this attribution table, which can be very helpful. The book itself is laid out in a question and answer format so that when you click on the chapter, you will find all the questions that are answered in that chapter. And if you click on a question, you will quickly see the answers to the questions as well as several examples that are pertinent to that question. You'll also see in blue direct links to the source material. In this case, Darren is referencing a code section. If you click on it, it will bring you directly to that code section that you can read and go easily back to where you were just by clicking on the tab. This particular link is a benefit link article written by Darren and will take you right to the benefit link article. Up here I see a case that's being referenced, and again, if you click on that, it will bring you to that source document of the case and go back to where you were very easily. All of the chapters in Darren's book are laid out in that same format and all have all the direct links to the source materials. If you have a question about anything that I have covered, or Erisapedia.com in general, if you want to ask that on your GoToWebinar question screen, I will stay on for a few minutes to answer those questions. If you don't have questions, thank you for attending both the webinar and this short demo. I'm not seeing questions. There's one other thing I probably might mention to you that Darren referred to in the presentation about if Congress enacts or turns on this relief. He talked about the statute 1400Q. You can find that here as well with the special rules for use of retirement funds. And there's some qualified hurricane distributions that they talk about with specifically Katrina. So if that happens, that's where you can find it on our site. And I'm not seeing any questions, so thank you for attending once again, and we look forward to your attendance at our future webinars.